Good morning and welcome to the Killik & Co market update. This week we had the latest inflation data from the US, which the markets responded quite well to. Arguably, US inflation is one of the most important data points for markets, and that's the reason we keep quite a close eye on it in these videos. The US inflation number for June came in at 3%, which was quite a way below expectations, and the number for July was expected to be slightly higher at 3.3%. It actually came in at 3.2%, so markets were happy that it came in below expectations. We can look at a more detailed breakdown of this inflation data. While the headline rate was 3.2%, the rate for food was slightly higher at 4.9%, and the rate for energy was negative at minus 12.5% due to the fall in the oil price that's taken place since last year. Markets were happy that the headline rate was below expectations, as this means that the chances of a US interest rate rise in September are now slightly lower. Here's the S&P 500 over the last 5 years. It's had a good run this year so far, and it's now not a million miles away from the highs of late 2021. The Investment Association has recently published some data on fund flows, showing what types of funds in the UK retail investors are buying into and what types of funds they're selling out of. The data shows money coming out of equity funds and into bond funds, particularly government bonds. In June, a net figure of £504 million flowed into UK gilt funds, and a net £618 million flowed out of North American equity funds. Here at Killik, we've also been seeing greater levels of interest in individual UK government bonds, which can be a tax-efficient option for some. These bonds are generally issued at a price of 100 and they mature at a price of 100, and they make interest payments which are called coupons. We've got two examples of government gilts here. The first has a low coupon of just 0.25% and it matures at the end of January 2025. And because the coupon is low, it's trading at a low price of 93.35. Anyone who buys it now will pay 93.35 and receive 100 when the bond matures in 2025. The gross redemption yield is the average annual return that the holder will receive, taking into account the interest and the difference between the purchase price and the maturity price. Bond interest is taxable, but there's no capital gains tax on bonds. So the net redemption yield for a 40% taxpayer is therefore very similar to the gross redemption yield, because almost all of the return is coming from tax-free capital gain. The second bond on the list has a higher coupon and a higher price. The gross redemption yield is similar to the first bond, but the net redemption yield is much lower at 2.98%, and that's because the interest is taxable. Do give us a call if you'd like to talk about this in a bit more detail. And finally this week, renewable power companies operating in the UK have been quite vocal about the costs of new renewable power projects. Costs of parts and labour and financing have gone up quite a lot in the last 2 years, which has caused problems for renewable operators who have committed to build wind farms and receive a fixed price for the energy these farms will generate. The rise in costs versus the fixed price of power is making some of these projects unviable, and the industry believes that the UK government needs to offer better terms if more investment in this area is to be encouraged. The rising costs are one reason for the weakness in the shares of some renewable companies, for example Ørsted, Siemens Energy and Vestas. Siemens in particular has had big problems with costs, as you can see by the sharp drop in the pink line on this chart. Do give us a call if you'd like to talk about these names in more detail. Next week is fairly quiet on the corporate calendar, but we have got results out from TJX, Adyen and Estée Lauder. That's it from us. Enjoy the weekend and we'll see you next Friday.